Hello, so we are going to learn more on L1 derivatives and we'll see payoff of call and put options and option breaks. So we'll still be on the basic level, but we'll see things in little more detail. So here I am instructor Prabhat Kumar and I represent Investors Delight. So as the call and put options payoff, we'll see how derivatives are there and we'll revise some of its concepts as we have already discussed. Then we'll see long and short call. We'll see it in little detail. Then we'll see types of traders, hedging using options, then option breaks. All these things we'll see in little depth. So as we have already visited this terminology, we are visiting once again. The price of contract is known as with the strike price or exercise price is something which is very important to know. And then we have to know the date of contract, that is when it is going to expire, is called expiration date or maturity. Intrinsic value is nothing but the strike price minus the stock price, that is the intrinsic value, and extrinsic value is something if we deduct intrinsic value from the premium or the call option, then we got to know that is extrinsic value. And the premium paid per contract is also called as the price of the option or the premium. Both are the same thing. So we are now onto the payoff diagram formula 1, where we will see payoff diagram of long call option. So K is the strike price, you can see here. So this is K, it is the strike price, and this is the stock price. So we know that the payoff from the long position in call option is maximum of st minus k comma 0 and minus c. So that's how you can see. So c is the call option, the value of call option is minus c, it is written here. So this is the value of call option. So as we deduct this call option from st minus k, we get the actual value in y-axis, that is the profitability. So this is the profit payoff from the call option. So as stock price st increases k, the payoff starts increasing. Prior to that, it is equal to minus c, but it starts increasing once st increases uh, k, the strike price. So this is the payoff diagram of long call. Payoff diagram of short call is also very much similar. Here the payoff from the short call position in call option is negative of maximum of st minus k comma 0 plus c. If you just see, just we are putting a negative here and minus here and a plus here, and this becomes the equation for the payoff of short position in call option. So this is just same. We can also restructure this statement as minimum of k minus st comma 0 plus call option. So this can be written as, instead of max we can make it as min, and instead of negative sign we can make it a positive sign, and we can write plus c, and that's how we can put this equation. So this is just to understand that as st increases from k to beyond k, then we see that there is decline in the profit potential and it goes on decreasing linearly. So prior to that, the highest profit that we are making is equal to call position, that is c. So that is something to remember here. Now it is another thing like put option. So put option is different from call option. Here we buy put option and we get when the stock prices decreases. So as long as stock prices is increasing and increasing beyond k, we are in loss of minus p, that is equal to put option premium. And as soon as it goes below k, we starts increasing in its payout, and that keeps on increasing, and this payoff from the long put keeps increasing like this, and its payoff equation is like max k minus st. So we deduct st from k and 0 whichever is higher, and then we deduct minus p. So this is the equation for this diagram. And again for the reverse case, that is selling put option or writing put option, we have the opposite equation of this one. So we put a minus here and we put a plus here before P, and this becomes the payoff from a short position in put option, and it can be restructured like minimum of st minus k comma 0. So instead of minus here we can remove minus, and instead of max we can make min, and we can write st minus k comma 0, and we can add this with p. So that way we can restructured this equation, and this is the equation from put option. So one difference between buying and selling, let me tell you, is that when you buy a call option, then you are easy to you are able to buy the call option or put option easily, because you will have to only pay the premium. But when you are going to sell the call or put options, then you are selling, so you will have to take lots of risk, because as a seller, as a sort of put, you are exposed to you are exposed to use risk. Means um, mm, in case you start losing, you may lose entire capital as the security price. So the security price, if it is like this, it goes to this is the security price, then you may lose up to entire capital also. So you will have to safeguard this loss, or you should have enough fund to support this loss, and because of that you will have to have enough capital before you want to sell a put option. Similarly, to sell a call options, you are exposed to very high risk. You may lose if a stock price goes indefinitely high during that expiry period. You may incur a lot of loss, because this equation will go so and so, and it can lead to loss which is unprecedented, and for that you need to have enough fund in your account. So writing a call or a put option is not an easy task. You need to have enough fund so that you can sell call and put options. But for buying, it is just like you pay the premium and you can buy. But sellers definitely make more profit compared to buyers, because this market favors sellers more than buyers. Now coming to the traders, we have different types of traders. Like hedgers are there. Hedgers are essentially spot market players, and they hedge their position. So they already have something. Like farmers can be hedgers, because farmers have their crops, and in order to lock the rate of their crops, they have to do hedging with some forwards and futures. And because of that, farmers or some merchants who have some future receivable in some currency, they are all hedgers. They lock the interest rate for some reason, and because of that they are hedgers. Now we have speculators. Speculators wish to take a position in the market, either by betting that the price will go or down. So they don't have clear idea as to what will happen, it will go up or down, but they speculate that this is by the market conditions, there are more chances that the price will go up or the price will go down, and accordingly in that scenario they take some decision and they take some contract. And because of that, they are speculators. They may lose the fund, they may gain the fund, but if their expectation or their thinking or their intuition is much better compared to what others thinks, then they are definitely going to make profit. Yeah. And then we have arbitrageurs. They are arbitrage involves in locking the riskless profits by simultaneously entering into the transaction in two markets for the same products, and buying from one market where it is cheaper and selling in another market where it is at higher price, and getting the spread as their profit. So they are arbitrageurs. There are sometimes opportunities of arbitrage in banking, in various currency related things also, in various commodities related things also, and many players in banks also try to make use of those opportunities and try to make riskless profit. Then we have hedging using options. Consider an investor who in May 2007 owns 1,500 Reliance shares. Now the current share price is rupees 1,700 per share. Now the investor is concerned that the share price may decline sharply in the next 2 months and wants protection. The investor should buy 10 July put option contracts with a strike price of 1750 on NSE. This would give the investors the right to sell 1500 shares of rupees 1750 per shares. So this way, this kind of hedging can be done. This is a live example of hedging. So that way hedging is done. This hedging is in terms of reliance share. It can be done in terms of crops, in terms of metals, in terms of gold, anything. So coming to the Greeks, we are going to see what are the Greeks. So we have delta as Greeks, we have gamma as Greeks. So delta, what is delta? Let us see all other Greeks also in brief here. So delta is the risk measure that impacts the options price for unit change in price of the underlying assets. For example, delta of zero point 0.4 USD means that the options price will increase by 0.40 USD if the underlying asset price increases by 1 USD. A deep in the money option will usually have a delta close to plus minus 1. A far out money option will have a delta close to 0. So this is the kind of things that you can understand. If something is in the money, its delta will be close to 1. If it's out of the money, its delta will be close to 0. And a delta close to zero point 0.5 means only that price will increase by zero point 0.5 USD if the underlying asset price increases by $1. So this is what you have to understand. Gamma is something like delta only, but here it is the double derivatives of mm, security or single derivatives of delta itself in terms of the underlying. So if a gamma of USD is 0.05, it means that delta will increase by USD 0.05 for each dollar change in the underlying price. So that way we can understand delta and the gamma. And now we will see what is lambda risk. So very close to the gamma, the lambda is defined as the percent change in the option price for a percent change in the underlying price. So it is like gamma only but little different. And then we have theta. So theta risk measures the impact on the options price for a 1 day change in time remaining to the expiration. Similarly, kappa, we call it also Vega risk. So this is the options price affected by changes in the market's valuation of implied volatility. And Rojo risk is the last variable, the Black and Scholes models, and it is the risk-free interest rate. So that's how we complete all the Greeks here. And with this, I would like to say a thank you, and we'll meet in the next section.